Do you have a pension? If so, should you take a lump sum or take an income stream? If that's a question, we are going to answer it in this episode.
We hope you've been enjoying all the episodes from Secure Your Retirement. If you'd like to keep learning and receiving these episodes, hit the subscribe button and the bell so you receive alerts when they come out. We've helped thousands of listeners get on the path to securing their retirement. Now it's your turn. Let's dive in.
Welcome to Secure Your Retirement Podcast. Merce and I are very, very happy to be able to talk with you today on topics that are something that we run into quite often. And today is one that we do run into quite often in our world when we're working with our clients or those that are looking to retire. And it really kind of comes around this idea of a pension. And here's the question. Should you take a pension as an annuity or as an income stream, or take it as a lump sum? And that's a pretty big question that people have. So just to give you a little bit of context, if you retired from a place where you actually could get a pension, some places that are common for that is this: if you work for the state of any state, or the federal government, or a company like IBM and maybe GSK are some common ones that you might have the option for a pension. And the way that's worked is you've put money over into that pension. Your employer has contributed over into that pension. And now what you will get when you get ready to retire, you can get a statement saying, if I retire now or I retire in a couple years, what would be my income? And I could take that income, or it will tell you you could take a certain amount as a lump sum. And so the question comes out, which one is better for me? And that is not as easy as saying one or the other. There are pros and cons. There's things to think through. There's scenarios that we have to run. And so when people come to us and they ask that question, what we say is, that's a great question. We need to look at your options. We need to do some analysis. We need to take you through the risk. We need to take you through the pros and cons so that you can make a truly educated decision. So today, what we want to do is kind of walk you through that format so that it's kind of in your mind as to what that all might mean. So now what I want to do is just kind of go in, and what we're going to do is we're going to say, what are some of the options? So Merce, can you kind of walk us through what some of those options look like?
Yeah, absolutely. And I was just thinking as you're talking, that if we did do this podcast in 10 years, while today we are saying we see this quite often, or having to make this decision quite often, 10 years from now, I don't know that this question may not exist anymore. I don't know, because a lot of us know that pensions are kind of going away, but the clientele that we work with, they may be the last few that are getting the option for pensions outside of just federal government and stuff like that. But anyways, that was just a side thought that I was thinking as we're talking. So when it comes to options around pensions, you've got really two. If we make it simple, you've got two options. One is you take the option as an annuity payment or some element of a income stream. And then the other option would be, and if it's allowable, and I think in most cases it is allowed, some do not, but in most cases you have the option for what's called a lump sum option, or basically you take the value of the pension account for yourself. So there's things that you would want to think about for sure on the annuity option or the lifetime pay type of option. I would call it bells and whistles. So the first option that you would have is to take an income stream based off of what is called single life. And that in most cases is going to be your highest possible potential payout. But if something happens to you, there is nothing left. There is no account value. It goes away. It doesn't go to your heirs or beneficiaries or spouse. And then why I say bells and whistles, if we attach bells and whistles to it, like I want to cover my spouse in the event that I pass away, or I want to maximize for myself, but then maybe 50% of what I was receiving goes to my spouse if I pass away, or 25 or 75%. So there's a lot of different options when we start to elect for covering the spouse in that pension decision, if we're taking it as an income stream. And so to me, those are the bells and whistles, basically saying, hey, the more risk that you're transferring to the company to cover someone else's life, in most cases, the less benefit that you're going to get, because it's not just covering you, it's covering someone else for the duration of both lives. And when you think about it that way, yeah, of course, if I'm asking them to do more, it's going to cost me some way, somehow. And so there are things that we would absolutely want to consider when it comes to taking the annuity option. Same as with the lump sum. So let's say you say, no, I don't want to, I don't need the income stream. I'd rather just take the asset, the value of it. One misconception is, hey, if I take it in lump sum, and I put it into my bank account, I'm going to have to pay tax on it, and that's the only way to do it. That's it's a way to do it. It would be the most uncommon way to do it. The more common way that I think gets forgotten about is that you can actually roll it into an IRA to avoid any of that taxation, just like you would roll a 401k into an IRA, and that avoids the taxation on it. And now you've got full flexibility to manage it. So those are really the two big ones. Is, do I take it as an income stream? Does that fit my financial plan the best? Or do I take it and put it into my own IRA so I can invest it myself?
Yeah, I was just going to say on that point too, some of the things we look at is, let's just say that you're looking at it and you think, well, I kind of like the idea of having an income. There's really a third thing that we will do, depending upon how that looks, is that we could say, well, what if I took it out of the company plan and what their income is, and I went and looked for another vehicle, like another insurance-based annuity that would give me a guaranteed income. And what we find that way is that I don't lose some of the benefits that I would lose if I took the single life annuity. So for example, if I take the single life annuity, and let's just say I said, I'm going to base it on my life, I'm not going to do spousal benefit, and I were to take it for 1 year and die, it's over. If let's say I had a lump sum value of $500,000, just to make it easy, then I got this income amount and I take it for 1 year, and for whatever reason I die, my beneficiaries get nothing. So some people would say is, well, I'm going to put it on my spouse. Well, now I take it and then my spouse passes away as well, early, in maybe 5 or 10 years, and my beneficiaries get nothing. We can move it over to vehicles that will give you guaranteed lifetime income, but it really kind of draws down on the principal, so that if I did pass away early, the balance will go to my beneficiaries. So it's not always just, do I want income or lump sum? It could be like, do I want lump sum income in the current location, or do I want to compare income outside of the current location? So again, that's why we talk about this needing an analysis when it comes to that. Now, one of the things we talk about is that I told you we've got pros and cons, right? So if I take the money out and I say I don't need the income, I just want to take the money out, invest it. Well, what's my risk? Well, I could lose some value if the market's down, if I invest it in something that's got risk on it. So there is some things there I got to think about. But usually if somebody is saying, I want the cash balance, I just want to take the money out, pretty much what that translates to is that they've been a really good saver and they don't need that guaranteed income. They go, nope, I've got enough assets that I'm going to be able to be fine without needing that guaranteed income. If I'm in a scenario where I say, no, I need that income because I don't have much savings out of that, well, then now we need to look and say, which place am I going to get the most income with the most options? And I think that's the really important thing. Oh, by the way, I forgot to say this. There are outside or external vehicles that would not only give you income, but could give you some benefits if you were to have something like a long-term care type scenario. Like say, for example, you needed help with 2 activities of daily living. It could actually double your income for a number of years, and you still have lifetime income that you cannot get in a company plan. So there are some really key benefits there as we look at this. But I'm going to just kind of go back and forth with you on this, Merce. Here's some key questions that I think that we have to think about. So these are questions as you're doing this to just consider. Number 1, do I have guaranteed income sources if I'm kind of making this decision? So again, this comes back to, I think, income sources, but also assets. So if I've got enough assets that I'm not going to pull down my assets very much, that's called pretty much guaranteed income sources, right? But I could have, a lot of income coming in from maybe already a pension that maybe one of the spouses is taking, or I've got good sizable Social Security, whatever that might be. We just really need to do analysis on how much secure income do I have.
Right. And then another big one to consider as you're asking yourself, which decision do I make? And this one's not truly fair, but you can make an educated guess around life expectancy. If you do not have a strong life expectancy in your history, or you just have a feeling, the amount of times we've been in meetings and someone say, "Yeah, I'm not living that long." I don't know where you get that feeling from, but you kind of know. Um,
Or you got a health issue.
or you got a health issue, right? So the life expectancy is shorter. It may lean you towards, well, I don't need to take the lump. I don't need to take the income annuity guaranteed for life. I may as well preserve that asset so that somebody gets benefit of it by taking the lump sum, taking what I need while I'm living, but then I leave some of it behind in some way, somehow. Another big one is, well, do I have desires to leave money behind as a legacy type of plan? The traditional income pension type of annuity is not doing anything around legacy planning, whereas keeping it as a lump sum could be. Uh, if you're going the lump sum route, you got to find a way to manage it, right? So, do you work with an advisor or not? The big thing that Radon talked about is we do a big analysis on how do we want to invest money that we're investing. We talk about risk, we talk about safety, and how do we fill those buckets up. Uh, Tax considerations is something to think about too. Although in most cases it's not changing one way or the other because it is pre-tax money. One key thing though, if we do take the lump sum, it does now open up the option, the potential for doing Roth conversions on that money in the future, which is something that a lot of people are talking about right now is, are my taxes going to be higher in the future than they are today? And that points towards Roth conversions. And also covering the spouse. Do I need to cover the spouse with a guaranteed income stream or not? Or are the assets that are left behind going to take care of the spouse? So a handful of things to consider for sure. Radon, you were telling me that you have a client, or we've worked with a client that had this exact scenario, and you wanted to tell that story.
Yeah, I got two. I kind of want to tell both sides of the story. We have a lady who's been with us now for, I don't know, about 12 years, and she retired from the state of North Carolina. And she was in this predicament of, do I take the lump sum or do I take the income? She had about 5 or so years left of work. She had changed jobs, but she had this pension. So what we showed her is that if she moved that pension to an external type pension, not inside the state of North Carolina, and we let it defer for 5 years, it was going to increase the amount of income she was going to get by about 30%, meaning she was going to get 30% more income. She had now the activities of daily living or long-term care benefit, and we increased her income by 30%. Now she's been retired now for somewhere around close to 7, 8 years. And I'm going to tell you that she comes in the office all the time and says, I can't believe it, because she says, I just have had a fantastic retirement. I don't have to worry about income. Oh, by the way, if she were to pass away, she still has a significant lump sum that would go to her beneficiary. So it's been a very positive experience. But in order for her to make that decision, she had to do the analysis. A second one that just came up, this one's very recent. This is the opposite of the scenario. This was a very, very good saver. He had done a lot of work in saving, had money in 401ks, money outside of 401ks. He had a lot of has a lot of rental properties, has a business that still generates income. And so when he looked at the lump sum versus the income, he goes, I don't need the income as a guaranteed income. Why would I leave it in the pension and take that guaranteed income when I don't need that? I'm just going to save it anyway. Why don't I move it out? That now has opportunity for us, because it went to an IRA, for us to do planning like Roth conversions, to get that money now that's going to be coming out that would be taxable into a tax-free status for his beneficiary. So we're really doing this as a beneficiary benefit more than we're doing it for their benefit, because they said, look, we know at the end of the day we're going to leave money behind. And that's a very common scenario. So the pension, if he did the pension, it would not leave as much money behind. We could not do Roth conversions once we start the pension. And so overall consideration, super happy. We took the lump sum, put it in an IRA, and now we can do those conversions. Any final thoughts there, Merce?
And I was just going to say, so bottom line, clearly there is no one size fits all type of answer here. I think in our opinion, everything starts with the building out the retirement focused financial plan that helps us look at the entire picture. Once we understand the entire picture, then we're able to make decisions on each and every little piece of the pie, like a pension or like a Social Security decision or like investments. And so that's what I would say is that if you've got questions or you have a pension and you need to make a decision, we are happy to, help you think that through. We've done it so many times for our clients before, and we've got a whole system in place to help make those decisions. We have a lot of tools in the tool belt too, to help you give you comparisons as far as this or that and what makes sense for you. So we're happy to have that conversation with you.
All right. If you were to want to have a conversation with us about this or any other topic, we would be more than happy to have that conversation with us. And it's super simple to do. Just go to our website, pomwealth.net, go to the Contact Us page. You'll be able to go in there and fill out your information, and we can schedule a call, and we would be glad to do so. We hope this has been beneficial. We'll talk to you again next Monday. We hope you have enjoyed this episode of Secure Your Retirement. If you would like to learn more, we have actually created an online course called 3 Keys to Secure Your Retirement. This video course helps you to think through all the different steps as you get ready to plan for and live throughout retirement. You can access this by going to our website, pomwealth.net. In addition, you can also subscribe below to our podcast called Secure Your Retirement.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.